In CAPM, there's also another line in addition to the CML. This line is known as the Security Market Line, or SML. The SML is used to determine the correct expected return for all individual stocks. And once we have the correct individual expected returns for stocks, we can use those expected returns to value the stocks. The SML uses the stock's sensitivity to the market risk, the non-diversifiable systematic risk, as a basis for pricing the stock. And the SML line looks something like this. On the vertical axis, we have the expected return for the individual stock. And on the horizontal axis, we have beta. And recall CML, the CML horizontal axis has sigma on the x-axis. And this is the main difference between the CML and the SML. The SML only deals with individual assets, individual securities. And here, the argument is that for securities to be priced correctly, for securities to be priced correctly, their expected return must lie on the SML line. So they must be on SML. And if they're not on the SML line, then if the expected returns are not on the SML line, then the securities are mispriced. And we'll see some examples of that shortly. The SML line equation is the expected return of asset I equals the risk-free rate. Not really sure why there's a bracket around that. The risk-free rate plus the stock's beta, the stock's sensitivity to the market risk, how much market risk the stock is exposed to. Recall, the market only rewards or compensates people for taking on non-diversifiable systematic market risk. Any risk that's diversifiable away is not compensated for. So this beta represents market risk. And beta is multiplied by the difference between the expected return of the market portfolio and the risk-free asset. And sometimes this is called the market risk premium. The premium that the market portfolio pays on top of the risk-free asset. And beta mathematically is calculated if we run a regression with some historical data, then beta would just be the slope of the regression line. And mathematically, it is the covariance of the returns of stock I with the market portfolio, all divided by the variance of the market portfolio. And here, a cool thing is if we calculate the beta of the market portfolio, then that becomes the covariance of the market portfolio returns with the market returns itself, all divided by the variance of the market portfolio. And for those of you who are good at statistics, the covariance between something and itself is just the variance. So that becomes the variance of the market portfolio, and that just becomes 1. So the beta of the market portfolio is standardized as 1. Whatever has a beta of 1 has the same level of sensitivity, the same level of market risk as the market portfolio. And here's a table that shows the different interpretations of the different ranges of beta. When beta is equal to 1, as I mentioned, the security has the same level of sensitivity, the same market risk as the market portfolio. When beta is greater than 1, then the stock has more market risk, more sensitivity to the market portfolio than the market portfolio itself. And when the beta is in between 0 and 1, then the stock price, the stock has less sensitivity to the market portfolio, to the general market conditions than the market portfolio itself. And finally, when beta is 0, the security or the asset has no market risk. In this case, the security or the asset is risk-free and should be compensated with the risk-free rate. Here is another table that shows some of the advantages of the SML, using the SML equation to calculate the expected return of a security, and thus using that expected return to value the security or the asset that we're examining. The SML explicitly considers risk in the form of market risk, and it's relevant for most companies, especially those ones that are publicly listed. And some disadvantages of the SML: if the estimate of the market portfolio and the betas are inaccurate, then essentially we're getting garbage out because we're putting garbage in. So garbage in, garbage out. And the estimates are only as good as the data that we use to estimate the beta. And historical data is used to predict future returns, which is always a flaw in a lot of finance models. Recall, finance is forward-looking and oftentimes looking backwards at history. History, if it's not relevant, then it won't be relevant going forward. And the SML is not applicable to private companies. And if we have a portfolio of several assets, we can also calculate the portfolio beta, the beta of the portfolio that is comprised of several assets. And if you guess that the beta is just the weighted average of the individual asset betas making up the portfolio, then you would be correct. The beta is just that. It's the weighted average of the individual betas making up the portfolio, weighted by the percentage of the asset that makes up the portfolio, by market value. So for instance, this is the market value of stock I as a percentage of the value of the portfolio, the market value of the portfolio. And obviously the weights always have to add up to 1. And the security market line is often confused with the capital market line. So SML versus CML. And it's understandable because both of the lines are in the CAPM world. The security market line only deals with individual assets, whereas the capital market line deals with a portfolio of assets. And the security market line has expected returns on, well, both SML and CML have expected return on the vertical axis, but the SML has beta, systematic risk, on the horizontal axis, while total risk, sigma, is on the horizontal axis for the CML. And finally, the SML is used for individual assets.